All right. Good afternoon, and welcome back to this month's strategy dashboard with myself, Laura Livingstone, and David Kletz. David, thanks for hopping on today.
Thanks for having me, Laura.
All right. So you've titled this month's strategy dashboard Rate Expectations, and you open by saying the key issue that we're facing right now is no longer whether inflation is reemerging, but whether the central banks will respond forcefully enough to it. And you're calling it the classical central bank dilemma. Can you unpack that a little bit?
Yeah, it's clear that although oil has a lesser impact these days on global GDP than in previous decades, oil is still a critically important variable and feeds into everything, not just gasoline prices, but transportation, which feeds into food prices and everything else. And we've had elevated oil prices for a few months now, and that's clearly feeding into headline inflation. That wasn't necessarily a problem in and of itself if the oil price shock proved to be very short lived and transitory. But because we've been contending with this situation for a while now, um, the concern is that this pressure on headline inflation is starting to bleed through into core inflation, which would be baskets that exclude energy, food, and other more volatile items. When that happens, that's when central bank interest starts to pick up quite a fair bit because one of the key things that central banks don't want to happen is for inflation expectations on a longer term basis to start to adjust higher and potentially become unanchored. So the concern now is shifting to whereas previously everyone was talking about Fed rate cuts and things, but now the focus is shifting to will central banks have to hike rates? And if so, how aggressive will they be? And for this particular situation, I've called it, a bit of a dilemma because um, we have oil-driven inflation, which weakens real incomes for consumers. It raises input costs for corporations, um, and then if you are to tighten policy on top of that, it can amplify the hit to economic growth, which isn't a particularly favorable situation. So a lot of central banks have a dual mandate to support either labor markets or the economy and manage inflation, even if inflation is the primary goal. And this situation kind of puts those two things at odds with one another. And just the last point being that when you have an oil supply shock, as we currently have right now, even if it is potentially transitory in nature, central bank policy, raising interest rates, for example, doesn't really do much. It's pretty ineffective at dealing with a supply shock. The supply shock is idiosyncratic in nature, and central bank policy is ill equipped to deal with those types of scenarios.
Yeah. And you actually note in your article that in a way, markets may already be doing some of this work for central banks with long-term bond yields moving sharply higher. We actually just discussed this in our most recent Ask Poor Strong.
Yeah, exactly. So markets have quickly repriced policy rates for central banks. That's at the short end of the curve, but also at the longer end of the curve, we've seen um, quite a lot of pressure to the upside on long-term developed market government bond yields. And this is in reaction to, I suppose, an acknowledgement of burgeoning inflationary pressure. And that also has, an economic impact to it as well, too, should it be sustained. Whereas, long interest rates impact mortgage rates, it impacts corporate financing costs, and just general financial conditions as well. So, irrespective of the decision from central banks to tighten and how aggressively to do so, the market is essentially moving in advance of any of those decisions right now.
Yeah. Let's talk about the context and what this is happening. We're at a different point, like a starting point than 2022 oil price spike. And we entered 2026 with a robust global economy. With all that in mind, what is the importance really of the duration of these long-term outcomes?
Yeah, so obviously the concern here is that a central bank tightening cycle would kill economic momentum and put the global economy into a recession. That is a very classical outcome where central bank tightening does that. But I think comparisons to 2022 and the aftermath of Russia's invasion of the Ukraine are a little bit wide of the mark because there's some key differences. I mean, now first of all, I think your comments are valid with regards to the global economy. There's a number of major trends unfolding right now that are supportive of growth, and those being an expansion in trade activity, fiscal stimulus from a number of different major economies, and also on the corporate side, an extremely potent capital spending boom tied to AI. On the inflationary side, I think it's also quite a bit different too, because in 2022, we had a lot of supply chain impairment coming out of COVID, and prices were already accelerating fairly rapidly even before the oil price spike. The oil price spike effectively just poured fuel on the fire. And this time, labor markets are actually modestly cooling, not potentially in a overly negative way, but comparing that again to the early 2020s, labor markets were running much hotter. So I think net net, the risk to the global economy is somewhat lower, and the inflationary pressure that we could expect to see coming out of this scenario. Admittedly, it's a quickly changing scenario with all of the geopolitical developments, but that inflationary pressure we would expect to be less potent this time around.
Mhm. So, while impossible to make predictions on how this is going to pan out, the geopolitical volatility that we are kind of looking at, what are we doing with our strategies at this juncture?
Yeah, so I mean, our view for the time being is that the global economic growth that we're seeing should be durable enough to withstand some modestly higher inflationary pressure, modestly higher interest rates, and oil prices at or near current levels. Now, clearly, the devil's in the details here in terms of timing. The longer oil prices stay high for, so particularly the longer the Strait of Hormuz stays closed, as an example, um, the more of an impulse you can start to get and potentially a more forceful reaction from global central banks. So it's something that we need to monitor extremely closely. But for the time being, I think it makes most sense to stay invested, keep strategies aligned with some of those very durable themes that are supporting global growth, like I mentioned, and also just stay widely diversified. Don't over concentrate allocations in any one area to reduce some of the idiosyncratic risk, as we certainly are contending with a lot of volatility in both global financial markets and the global economy as well.
Great. Thanks for your time today, David, and we will see you next month.
Thanks again, Laura.